Hi, everyone. Welcome back. Brandon, thank you so much for being my guest today.
Absolutely. Thanks for having me.
Yeah, so just so everybody knows, you and I have known each other for, I don't know, a couple of years now. And, we've done a bunch of deals together. You're on my lender list, but you are definitely one of my go-tos when I'm referring out to my
Thank you.
clients. Yeah, and I wanted to have you on today as the guest. This is kind of a part 2 to the last episode, and we're talking about refinancing. I've mentioned in the last episode that I think it's a stupid phrase to say date the rate, marry the house. But what that implies is that people can refinance down the road. I've also found that this is a phrase or a concept that's sold to first-time home buyers, and they're already really confused about the process potentially. There's a lot of information you're taking in, a lot of information you're pushing out to somebody else. And so to tell them about a refi in the midst of that might not resonate particularly well with them,
Yeah,
right?
yeah, absolutely. They're definitely being flooded with information, and in a time where they're
Right.
trying to make a big decision, anyways, on purchasing a house in the first place.
Right. So, with the implication being that many people might be considering a refi down the road or they've been told that they should have one, I thought it would be good to do an episode that discusses refinancing in general, both for what people are kind of anticipating, but really just all of the reasons why you might want to refi, so that people kind of have an understanding. And then we can kind of talk about the process so people really understand, like, what does that mean? So let's start by just talking about refinancing and things to know. And I don't know if you want to kind of start us off, and I can interject with what I know, which is assumably is a lot less than you know.
Well, yeah. First of all, let's talk about the assumption that rates are going to come down. That's the biggest thing that I try to do with my clients who are buying and have maybe some hesitation about where rates are right now with this big decision is let them know that when rates do come down, we're going to help take care of them when that happens. So
Sure.
essentially, if they're looking at rates, let's say rates today are 7%, they can understand that a 6.5% rate would be better than the 7% rate. So they understand the general idea of a lower payment, but they don't really understand what it takes to get from their current loan that they've agreed to get into that new payment, which is a whole nother loan, like you're doing another loan from scratch. In our situation, what we're hoping when rates come down next year is that we're pretty familiar with these clients, and we are not doing a ton of digging into them all over from scratch, but it is going to be a new application and a new loan, very similar to the process they've gone through when they purchased the property.
Yeah, I think that was the first and major thing I wanted you to touch on, because I refinanced my first condo, actually multiple times, twice, 2 or 3 times. And I thought it basically was just like, oh, hey, we just like write some addendum and all of a sudden, like, we refi and I pay $150 less a month or whatever. That was not the process. You actually even go to closing. I went to closing and had to sign everything again. So people understanding that not that it's not simple, but it's not just a matter of signing a piece of paper.
Correct. There are. I mean, they're over the years they're having different programs, and different lenders offer different options where maybe you can do a quick version like you thought in your head, but for the most part, people are doing a whole nother application, another credit pull, verifying their income and their assets and making sure the property's worth what what it needs to be worth for the loan, whether that means an appraisal, or sometimes they're not required, but there is some type of valuation that's being considered in that process of doing that new loan.
Right. So there could be an appraisal. There's going to be a title
Yep.
search, the application fees. So that all does happen again, notwithstanding any kind of special programs. Of course, we have to talk in generalities so that people kind of get the gist, and they'll obviously be following up with their lender or a lender to go over all the details. So that the general understanding here is we're talking in kind of broad spectrum
Yep.
today.
And then another big thing when you're kind of going through these line items of fees is going to be the transfer taxes. That's probably the biggest one that varies by where you are. In Virginia, you're going to pay transfer taxes on your loan amount. In DC, you don't really pay a transfer tax, but in Maryland, most times you won't. In Maryland, I think it's really just about the loan amount itself if you're taking new money out. So if your loan amount is increasing, even if it's just by a couple $1,000s to cover those closing costs, or if you're taking cash out, you're going to pay taxes on the new money that's being borrowed versus the full amount like you would in Virginia. So for people who aren't in our area, it's going to vary state by state, and that's probably the thing that varies the most among those costs.
Right. And you kind of implied this, but I'm just going to directly kind of say it too, is so you're doing a new loan, which means you are not taking over the length of the existing loan that you have. So for example, if you had a 30-year loan, this happened to me, 30-year loan, you've paid 3 years, so you're at 27, and you do your refinance, and and in my case, it went back to a 30-year loan, a 30-year, agreement. Now, we'll get to more specifically later, but it overall ended up being a benefit to me. But, you get this amortization kind of schedule when you do a closing, which literally for people who haven't closed is every single payment you make towards your principal and interest for the life of your loan. And it's like just numbers.
Payments are all broken down. Yep.
Exactly. And so you get that exact same sheet that goes back to 30 years in my case. So this is not anything that would stop you from refinancing, but we want to make sure people get it, because nobody wants a shock like halfway through doing something where they think maybe this wasn't a good idea, right? I mean, ultimately your lender is going to make sure it is a good idea, or a good lender will. But yeah, okay.
And we're also, like many of the things we're going to talk about today, it's really a case by case depending on what's important to the end user, the client, the person that's doing the refinance. Is it important to them to stay on that path of paying off the home within the original 30 years? Or would they rather take the lower payment and going back to 30 versus staying on 27? So some people really are it's very important to them. So what we do is we figure out what that payment needs to be to keep them on that 27-year plan, and we can set that up for them with their automatic payments.
Okay. I thought, well, this is good. I'm learning something too, everyone. So this is great. I mean, I'm not a lender,
and
so.
And it really, it really depends on what the purpose of the house is or how long you're going to be there. If it's your forever home, a lot of people are incentivized and trying to pay it off as quickly as possible. So they're, they don't want to go back to 30. They want to stay on 27. They'd rather pay an extra $30 a month or whatever that number may be to stay on that original plan. Or maybe they'll pay the same amount, and this is what we see a lot as well. I'm maybe jumping ahead here, but maybe they're not even trying to lower their payment. They just want to pay less interest or pay it off sooner. So maybe they'll pay the same amount. Instead of being at 27, they'll go to 25. So it's really just, it's so personalized to whoever is doing the refi and what their goals are.
Okay, so maybe this is a good time for us to talk about when you would want to consider a refi. And we're dancing around this, but let's just overtly outright just say these times when you might want to refi. So the first one is kind of obvious. It's when you want a lower interest rate,
and
which
with
is
that lower
kind
interest
of the
rate,
whole.
What I usually say is lower payment. So lower interest rate / payment, because really people who say they want a lower rate, they want a lower payment. They don't want to pay as much every month. So if rates have gone down, they want to have a smaller payment every single month, which is where you go into that 30, going back to 30. If that's what's most important to them is the payment, then it's okay for them to go back to 30 because that's the lowest payment option.
Right, which is what ended up happening to me. Yep. So, it makes sense. Well, I don't know. I mean, my place turned into an investment property. I moved on. And so, I will end up paying slightly less, over the course of however many years. But that means I'll have to have a renter for longer to cover all of those 30 payments. So, I mean, you never actually know what's going to happen in your life. You can plan as much as you want, but we all know life just happens. Yep. So, there's that to consider.
And in your case, it's easier for you to be cash flow positive with that lower payment, but it's going to take you a little longer to pay it off and be completely cash flow, if that makes sense. So, yeah.
Right. I have to have no payments minus my monthly condo fee or whatever, taxes. Yep. Okay, so lowering the interest rate, that's like a duh one. We want to maybe go into a next one that people should.
Another very popular one is getting a shorter term. So if you're going from a 30-year to a 20-year or to a 15-year, obviously paying that house off sooner, even if your payment goes up, sometimes you can accomplish more than one of these at the same time. When I bought my first house, it was at 6 1/4. And when I refied, I got it down to 3% on a 15-year, and my payment went down, and I had a lower rate, and it was a shorter term. So all of these things happened at the same time. So it's really just identifying them and figuring out, which ones can apply to you and which ones are most important. But the shorter term one is definitely a popular one for people who can afford that.
My guess is, does that happen a lot when people either start making significantly more or when just the value of their house goes up? Like, I don't know the specifics, but I'm thinking of my sister and her husband who refinanced a house that ended up becoming a rental property, and the going rent was way more than their initial 30-year payment. So when they refied into the 15, that was actually on par with the rent payment. So it made sense for them on multiple kind of. So I mean, I guess
Absolutely.
that would be something.
Yep,
Yeah.
and especially so. This is also very popular with my investment clients. I have a couple clients who, when rates were in the threes, the twos and threes, they took all of their properties that they had purchased with me as investments and flipped them from 30s to 15s. So for them, this is a retirement vehicle for them, and it gets them to that debt-free rental property much quicker. Even if they went from making a couple $100 a month to losing a couple $100 a month, they'd rather get there 15 years earlier and start realizing the full debt-free cash flow of the property.
Yeah, and or when they sell it, then they're just going to get cash minus.
Exactly, and that's another
Right.
thing we look at. If somebody says, well, what if I sell this house in 5 years, with a 15-year versus a 30, you're going to have way more equity and make way more profit off of that property by paying that extra couple hundred, if in that scenario.
Yeah, it makes sense.
Uh,
Okay, so I'm going to bring up the next reason why you'd want to consider refinancing, and this one is discussed a lot right now too. So ARMs, adjustable rate mortgages. Right now, actually, as of today when we're recording, I'm not sure how much lower they are, but for the last couple of months, ARM rates were pretty considerably less than your typical kind of standard rates.
yes.
And so people were being convinced at least discussing ARMs with their lenders, and it was a way to keep payments more manageable for people. But maybe just quickly, you should explain how an ARM works, so people know who are listening to this episode.
Yep. So
And then we can discuss the caveats of that.
so an arm has they're technically hybrid arms. So they have a fixed period at the beginning, and then they have an adjustable period afterwards. So the first number in the arm, so you typically see like a 5-1, 7-1, 10-1. That first number is the initial fixed period. So it could be fixed for 5, 7, or 10 years. Those are the most common options. The one afterwards means that's how often it's going to adjust after that initial fixed period. So 5 years fixed, every 1 year it will change. 7 years fixed, every 1 year it will change after that. Another popular one where you'll see 6 afterwards, so a 5-6 or 7-6, 10-6. That means it's changing every 6 months, not 6 years. That can be a little confusing. And then another one that I've seen is like a 5-5 arm. So 5-5 typically means it's fixed for 5 years and it only changes every 5 years. So that's another interesting one where it's not changing every single year after that initial fixed period. If you are still in a good rate after that 5 year period, then you got a whole other 5 years to see what's going to happen with rates, and you can kind of hang out in that mortgage a little longer.
Yeah.
But yeah, that's the real benefit in these is that they're typically a lower interest rate than what you would get with a 30-year fixed. And the idea behind an ARM, depending on what the use of the property is going to be, but the average person stays in their house 7 years, the average homeowner. So if you're only going to be there for 7 years, why pay this higher rate if you can have a lower interest rate and pay lower over that 7 years, and also have more equity in the property after 7 years by doing that.
Yeah, I mean, a lot of this comes down to what your plans are, because even if you're not going to live there for 7 years, I know a number of people that buy. I'm a perfect example. My first 1-bedroom condo ended up becoming a rental property. So
And that's a big thing to just that I make sure I hit on with all my clients is if you move out of this, or if it's a temporary place until you get another place, would you plan on keeping it and renting it? If so, then yeah, we probably need to look at, especially when we were in these historically low rates, like we probably need to get this thing on a fixed rate so you don't have to worry about rates or payments going up in the future.
Sure. Yeah, I mean, I had an example. It was years ago. One of my clients, I think, got on an ARM maybe during like the housing issue of 09, 08, 09, if that makes sense mathematically when it happened. But anyway, they were on an ARM, and their situation was kind of funky, but they ended up having to sell. They ended up having to sell it because I don't think they could refinance, and it was just the rate was going to be crazy. So that is a bummer when that
Yeah.
happens. I don't see it happen a lot, but I mean, again, it is something to consider because you just don't exactly know what's going to happen after that initial period. So,
Yeah, and
but yeah, so back to,
well, one
go
other
ahead.
thing on arms, they're all arms are tied to an index, so it's that's what's going to determine the rate in the future after that fixed period. So depending on what that index is, whether it's it could be LIBOR, it could be fixed, it could be tied to prime, it could be tied to the SOFR rate, secured overnight funds rate. So depending on which index that rate is going to be tied to, that's going to determine what the rate will be in the future. So 7, 10, 5 years from now, what are those rates going to be, and where's your rate going to fall, within that index.
I mean, I guess maybe we could do another episode on arms, but I think it's important for people who are on them to understand what you're talking about. Like what does happen after those years and how is it determined? We can't predict a lot right now, and we never can. So you're not going to tell them what that rate will be. Obviously, you can't do that. But at least so somebody has a working knowledge and understanding of how it will proceed,
Yep.
I think is pivotal.
Yep.
Yeah.
Absolutely.
Okay. So that's the arms situation. And the last one I have on my list, at least, is if somebody wants to tap into their home equity, or if they want to raise funds like in a financial emergency, if they want to finance a large purchase or consolidate debt. Admittedly, this is kind of my least the area I know least about. So maybe you can kind of speak to
Yep.
that.
So that's a cash out refinance, and at a time when rates were going down, this was a very popular option because if you had an interest rate of 4 or 5%, and you could take some cash out and get reborrow that money at 3%, sometimes your payment didn't even change, or it only minimally went up. At a time right now where a lot of people have 3%, 3 and 4% interest rates, and rates are higher than that, it's not as popular to tap into that equity because all the original amount you borrowed you're going to be paying more on that as well. But it's definitely something that can be helpful for people that need to tap into that equity, whether it's buying another property or consolidating debt, or whatever that may be that they want to tap into that equity for.
Yeah, I mean, again, this episode is being recorded in late 2022, but a lot of the things we're talking about will be applicable forever.
Absolutely.
So that people understand, like, again, when you might want to consider it, because people who refi down the road and end up getting 3%, that would be great. They might consider to do you said a cash out
Yep.
refi after
It,
that,
it,
because to my knowledge, you can refinance an indefinite number of
Yep,
times, right?
absolutely. There's no limit on when how many times you can refinance. So a perfect scenario of what you're saying, let's say somebody closes today with a 7% rate, next year rates go down to 5%. They bought this house that needs a little work. Next summer they decide, what, we're gonna redo the kitchen. We're gonna finish the basement. They can get that cost estimate, take that money out of the equity that they have, and if their rate's at 5%, maybe their payment doesn't even change at all, based on the principal that they borrowed. So
Yeah.
definitely
Yeah.
a good option.
So good
to
to
have.
know.
Yep. Another
Yeah.
another one that didn't really quite fall into those categories is removing mortgage insurance. So you
Okay.
can do that, and also changing loan type. So somebody that bought with an FHA loan that wants to get out of it and remove that mortgage insurance and get into a conventional loan, that's a reason to refinance. Or if you have a loan, even a conventional loan that has mortgage insurance, and you haven't met the requirements for your lender, whether it's number of years having the loan, or they whatever the lender has that's requiring you to remove it won't be met, you can always refinance to get out of that if the equity is going to be there.
Cool. It's a good
Yeah.
one to know. Okay, so something I read as far as the takeaway goes, if we're going to really kind of just sum this up, is that the rule of thumb is that you'll benefit from refinancing if the rate is at least 1% lower than the rate you have. Is that true?
I don't. I'm really like anti like these general rules. Like if you make X amount, then you should be able to afford X price. Like because
Sure.
everybody's situation is so different. So, really, it comes down to what are the new costs that you're paying for this new loan, and how much is it saving you, if you're trying to lower your payment, or you're trying to calculate a break-even analysis. That's what most of my refinance clients like to see is, if I'm going back to 30 years and I'm paying $3,000 to do this, how long is it going to take me to make up that $3,000 that I paid, or $5,000, or whatever that number may be. So we take their monthly savings and we compare it to the total cost to say, okay, well, in 14 months you will have made up that difference. So there's no real hard black and white number where it has to be. For lenders, there is a requirement. There's like a net tangible benefit requirement or a benefit to borrower requirement, where we cannot do a loan that's bad for a client. So you can't just, have somebody have a higher rate and a longer term and, all of these negative. There has to be some benefit that we can prove based on a lot of these things that we just discussed here. So you have to show that it's actually improving the financial status of the client that's doing the loan. So if it doesn't, then the lender should not be able to do that loan in the first place.
Well, let's hope nobody would get to that position anyway, where they would being kind of coerced into a loan that wasn't good for them. But okay, so more to the point, I think then, as opposed to this rule of thumb, because there is none, you or a person should consider the overall monthly savings.
Yes.
And is it enough to make a positive change in their life? Whether it's the overall savings over the course of the loan that will benefit you, or whatnot. And of course, you go in with the best, thoughts of what you want and what you think is going to happen. And if those things change, then you have options.
And this kind of takes me back to my, we were in these refi years for so many years that my first question when somebody calls me and says, hey, I want to refinance, I say, what is the goal of your refi? Like, what are you trying to accomplish? So it kind of helps me pick which of these categories they're going to be going in. And then I can kind of sort to see and make sure it's going to make sense, or that it's going to actually have one of these benefits for them. So sometimes people think that the lower rate's going to have a lower payment, or they're going to, they don't realize this cost is going to be there. And if it's going to take them 36 months to break even on the cost of the refinance, maybe it doesn't make sense to do that. And I can show them these numbers and say, you'd be better off paying an extra $50 a month on, and you'd pay off your loan quicker, or, whatever that case may be for the individualized person. But you definitely want to sit down and look at the numbers and make sure that it makes sense.
Yeah. I mean, it looks like it sounds like you have a holistic approach to dealing with the situation, and you're very upfront and communicative, which is exactly how I operate, which is why you're on my lender list. But anyway, okay, well, I think that's a good place for us to stop, and for us to make sure that if anybody has more questions, they can reach out to me, or more likely to you, because you'll be able to talk at great lengths about this. But again, thank you so much for coming on as my guest, and I'll make sure to link your information at this episode so people can get in touch if they want.
Right. Thank you. Thanks for having me.
All right. Take care.